Okay, so you want to own a downtown parking garage. You drive downtown and see the reality. Every spot is taken. People are circling looking for parking. A parking garage is full. The attendant is turning people away. Parking rates are $15 to $25 per day in major cities. Some charge $20 to $30. A garage with 500 spaces at $20 per day average is $10,000 in daily revenue. At 80% occupancy, that's $8,000 per day or $240,000 per month. Over a year, that's $2.88 million in revenue. The margins look extraordinary. Parking is just real estate. You own the land and the building. You charge people to park. The cost is minimal. Maintenance. A few attendants. That's it. It sounds like owning a printing press that prints money every time a car arrives. It sounds like owning a downtown parking garage in 2005 when downtown office workers were abundant, when work from home didn't exist, when driving to downtown was mandatory, and when parking revenue was the most reliable cash flow in real estate. That is exactly the comparison people are making right now. The parking industry generates over $30 billion annually in the United States. There are thousands of parking garages in major cities. Downtown parking is in perpetual shortage. Rates are rising. Demand seems infinite. But here's what is actually happening on the ground, inside downtown parking garages when the cameras are off and the actual financial statements are open. The reality of owning a downtown parking garage is completely different from what the perpetual shortage suggests. Some garages are still making money. Many are barely breaking even. And a significant number are losing money every month while watching their core customer base evaporate. The gap between the few that thrive and the vast majority that fail comes down to a handful of things that almost nobody explains before you invest $50 million to $300 million in a downtown parking structure. By the end of this, you will know exactly where the money comes from, where it disappears to, what the hidden structural shifts really are, and what separates the parking garages that still generate returns from the ones that became expensive real estate locked into a dying business model. What a downtown parking garage actually sells. The commute that disappeared. People assume that owning a downtown parking garage means you're selling parking spots to people who need them. You are. But that's not what's actually happening anymore. What a downtown parking garage actually sold was convenient parking for office workers who commuted downtown daily. Predictable, recurring, loyal customers. But here's the brutal truth that most garage owners won't acknowledge openly. The office commute is evaporating. Work from home is permanent. Remote work is expanding. Office occupancy downtown is collapsing. A downtown office tower that had 1,000 employees 5 years ago now has 400. The parking garage that relied on those 1,000 employees parking 250 days per year has lost 600 customers. But the garage's operating costs haven't changed. The structural vacancy rate has increased. The recurring customer base has evaporated. This is what's killing downtown parking garages. The secondary brutal truth is that the remaining parking demand is shifting. It's shifting to event-based parking. Sports games, concerts, shows. But event-based parking is unpredictable and seasonal. A garage that relied on stable 80% occupancy from office commuters now sees 20% occupancy on weekdays and 80% occupancy on event nights. Revenue becomes volatile. Operating costs become harder to cover. The recurring, reliable revenue is gone. Most garage operators haven't adapted to this reality. They're operating with labor, maintenance, and debt service structured around the old commute-based model. The full upfront investment, what actually costs money. Everyone talks about parking revenue. Nobody talks about the capital structure required to build a parking garage. Land acquisition, $5 million to $50 million. Downtown land is expensive. $100 to $500 per square foot in major cities. A 3-acre site for a parking structure costs $5 million to $50 million depending on market. Most garages are built on existing land or acquired properties. Cost, $5 million to $50 million. Construction and development, $15 million to $150 million. Building a parking structure is expensive. $50 to $200 per parking space in construction costs. A 500-space garage costs $25 million to $100 million to build. A 1,000 space garage costs $50 million to $200 million. Construction timing is 18 to 36 months. Cost, $15 million to $150 million. Parking management systems, $2 million to $10 million. License plate readers. Entry/exit gates. Payment systems. Software. Signage. Smart technology. Modern garages are high-tech. Cost, $2 million to $10 million. Permits and compliance, $500,000 to $2 million. Municipal permits. Environmental reviews. Safety certifications. Building inspections. Zoning compliance. Cost, $500,000 to $2 million. Debt service and financing, 60% to 75% of construction costs. Most parking garages are heavily financed. A $100 million garage financed at 60% is $60 million in debt. At 5% interest over 20 years, that's $636,000 per month in debt service or $7.63 million per year. The real total investment. For a legitimate downtown parking garage, the total capital investment is $50 million to $300 million depending on size and market. Most are heavily leveraged through real estate debt. The debt service alone determines whether the business survives. Where the money actually comes from. The revenue model that's collapsing a downtown parking garage's revenue came from two sources historically: monthly commuter permits, $150 to $300 per month; office workers parking daily. Predictable recurring revenue. A garage with 300 monthly permit holders at $200 average is $60,000 per month recurring. Cost of goods is near zero. Margin is 90% plus. Daily parkers and hourly, $5 to $30 per transaction. Tourists, visitors, event attendees. Higher rate but unpredictable volume. Less predictable but fills gaps. The historical model, 2015 to 2020. Text: 500 space garage, monthly permits, 250 spaces at $200, $50,000 occupancy, 60% times 250 spaces times $20 daily, $75,000 events/daily parkers. Remaining capacity $25,000 total monthly revenue. $150,000 annual revenue. $1,800,000. This model assumes stable office commute. But the commute is disappearing. The current reality, 2024 to 2026. Text: same 500 space garage, monthly permits, 100 spaces at $200, $20,000 office commuter daily volume. 30% occupancy, $22,500 events/occasional parkers, $10,000 total monthly revenue, $52,500 annual revenue. $630,000 revenue has collapsed 65% from the historical model. Operating costs have not decreased proportionally. The operating cost reality that destroys profitability once you own the garage and operate it. The costs are relentless. And this is where the parking garage business reveals why revenues collapse is devastating. Debt service, 60% to 80% of revenue. A garage generating $630,000 annually with $7.63 million annual debt service has negative cash flow before operations. Debt service alone exceeds revenue. This is the structural death spiral. Most older garages were financed when revenue projections were based on the commute model. Now debt service exceeds actual revenue. Labor, 15% to 25% of revenue. Attendants, managers, security, cleaning staff. A garage with paid attendants needs 8 to 12 people. Cost, $100,000 to $200,000 annually or 15% to 30% of revenue. Maintenance and repairs, 10% to 15% of revenue. Concrete repair. Parking equipment maintenance. Lighting. HVAC. Security systems. Ongoing maintenance on a structure is expensive. Cost, $10,000 to $15,000 monthly. Utilities, $3,000 to $8,000 per month. Electricity, water, sewer. A large garage uses significant utilities. Insurance, $3,000 to $8,000 per month. Liability, property, workers' compensation. A parking garage is a liability risk. Insurance is expensive. Cleaning and operations, $2,000 to $5,000 per month. Daily cleaning, snow removal in winter, waste management. The monthly cash flow for a typical downtown garage, a mid-sized 500-space garage in a major city. Text monthly revenue, $52,500. Debt service, $7.63 million annually, $635,833. Labor, $15,000. Maintenance and repairs, $12,000. Utilities, $5,000. Insurance, $5,000. Cleaning/operations, $3,000. Miscellaneous, $2,000. Total operating costs, $677,833. Monthly loss, $625,333. Annual loss, $7,503,996. This parking garage with $630,000 in annual revenue is losing $7.5 million annually. The model is structurally broken. Debt service exceeds total revenue. What parking garage owners don't account for: the structural collapse. Office commute collapse is permanent. 2020 was temporary. Work from home is permanent. 40% to 50% of office workers now work remote 2 to 3 days per week. Office towers are 40% to 60% vacant. The commute-based parking demand will never return. This is structural, not cyclical. Garage owners are operating with the assumption demand will recover. It won't. New garages are being built despite collapsing demand. Municipalities and developers are still building new parking structures. Supply is increasing while demand is decreasing. Pricing power evaporates. Rate compression accelerates. Competition intensifies for fewer customers. Alternative transportation is rising: e-bikes, scooters, public transit, delivery services. Downtown mobility is shifting away from personal vehicles. Young people, Generation Z and Millennials, are parking averse. They prefer other transportation modes. The long-term trend is fewer cars downtown. Technology is disrupting the model. Autonomous vehicles will eventually eliminate the need to park. When cars drop you off and park themselves miles away, downtown parking demand collapses further. This is 5 to 10 years away, but the trend is clear. The parking garage that still survives: you own a garage in an airport, not downtown. Airport parking is required. It's not optional. Business travelers park for days. The customer base is predictable and large. A 2,000-space airport garage generates $3 million to $5 million in annual revenue with 90% plus occupancy rates. Operating costs are $1 million to $1.5 million. You're generating $2 million to $3.5 million in annual operating profit. At $150 million financed for 20 years, debt service is $1.6 million annually. You're breaking even or slightly profitable. Airport parking survives because demand is structural. Alternatively, you own a valet parking service, not a garage. You partner with restaurants and hotels. You capture premium rates, $30 to $50 per car. You don't own the land. You have minimal capital investment. You provide a service. Labor is your cost. If you're efficient on labor, you generate good margins. But this isn't a garage. This is a service business. The bad scenario, the more common outcome: you own a downtown parking garage built in 2010 for $120 million. You financed $80 million at 5% over 20 years. Debt service is $850,000 annually. In 2020, the garage was generating $2 million in annual revenue. Occupancy was 75%. You had stable commute-based demand. By 2024, revenue has collapsed to $630,000. Occupancy is 40% on weekdays. You're losing $600,000 annually before operations even. Your debt service exceeds total revenue. You're forced to default on debt or sell at a massive loss. The garage is worth $30 million at current cash flows, not $120 million at historical assumptions. You've lost $50 million to $70 million in value and accumulated losses. Most downtown garage owners are in this position. The hidden cost nobody discusses: stranded assets. A parking garage that cost $100 million to build and finance for $80 million is now worth $20 million to $30 million based on current cash flows. The asset is stranded. You can't sell without realizing the loss. You can't operate profitably because debt service exceeds revenue. You're trapped. You're servicing debt on an asset that's economically worthless. The regulatory complication: some cities are starting to require parking minimums be removed from zoning. Some are capping parking rates to keep downtown affordable. Some are converting parking garages to housing. These regulatory shifts further undermine garage economics. An owner can't raise rates to compensate for lower occupancy if municipalities cap them. An owner can't force people to park if cities remove parking requirements. Conclusion: the actual economics of downtown parking garage ownership. Owning a downtown parking garage is a capital-intensive real estate business that was profitable based on a commute pattern that no longer exists. Most downtown parking garages are economically underwater. Debt service exceeds revenue. Operating losses are structural. The business model is broken. The money in parking went to real estate developers and operators in 2000 to 2020 who captured the commute era returns. The money now is gone. The remaining parking garages are trapped assets with negative cash flow. The separation between garages that survive and those that fail comes down to one factor: location type. Airport parking survives. Event venue parking survives. Downtown commute parking dies. Hotels with parking lots survive. Stand-alone downtown garages die. A downtown parking garage built for commute-based demand is an asset that will struggle for the next 20 years. Debt service will exceed revenue for the remaining loan duration. The asset will eventually become worthless or be repurposed as something else: housing, retail, etc. Most downtown parking garage owners are in slow-motion financial distress. Here's what parking garage owners won't discuss publicly. The asset they thought was stable income generation has become an anchor dragging them down. Debt service is fixed. Revenue is volatile and declining. Operating costs are fixed. There's no path to profitability. The only options are default, sell at catastrophic loss, or wait for the property to become valuable again for a different use. The downtown parking garage is dead. The industry doesn't realize it yet. But the economics tell the story clearly. Most downtown garages will be closed, converted, or defaulted on within 10 to 15 years. The owners holding the debt will face substantial losses. If you're considering owning a parking garage, understand that you're not owning a stable revenue asset. You're betting on permanent structural conditions, commute demand, office occupancy, that are disappearing. The risk is that debt service will exceed revenue for the remaining loan term. Most owners will lose money. The parking garage that worked in 2010 is an albatross in 2026. Don't become another casualty of the commute collapse.